training series with the mortgage calculator. See some people already tuning in. Thank you for tuning in early. We'll wait just a couple of minutes here to get started. Let everybody have a chance to jump on. Thank you for the comments. We put the chat up on the screen, so feel free to drop a comment as you tune in. I see some people were already commenting there. Owen, Julio, Nicole, thank you for the comments. We appreciate it. We'll get started here momentarily. Adam, thank you for the comment. Appreciate that. Feel free to keep dropping comments as well as questions too as we go through the training today. More than happy to answer any questions that anyone has pertaining to this training topic today, which we will get into here in just a moment. Annette, thank you for the comment as well. Thank you for everybody tuning in nice and early. Appreciate that. All right. It looks like we are live on all the different platforms. Thank you, Jules. Thank you, Michael, for commenting. Thank you, everyone, for the comments. Please, as you tune in, feel free to keep dropping comments there in the chat. We'll take it off the screen now, but keep dropping comments and then drop any questions you have there as well. Would love to answer any questions anyone has. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our President, Nick Hershey, and our Sales Manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do here every Tuesday and Wednesday evening is our loan officer training series, where we go through a different training topic each week. And today we're going to be talking about property title basics. So what is title? How does it work? And as well as going into title insurance and the issues you may find there, etc. So our sales manager, Jose Gonzalez, with 28 years of experience as a loan officer and a realtor, is going to go ahead and take over here and do a little presentation on title. As we go through here, feel free to drop any questions you have in that chat, and we would love to answer anyone's questions. So with that being said, Jose, I'll go ahead and let you take it over from here. You got to unmute yourself.
How's everybody doing today? All right. So here, today we're talking about title, right? Title, insurance, and how it affects your transaction. Title insurance and title in general, because we're going to touch a little bit on seasoning, but want everybody to be aware. I mean, even though we're not title agents, we are loan officers. Some of us also are real estate agents, and we have to be aware of certain things like chain of title, how that could affect your loan transaction, and about things like vesting and just the title commitment, right? Most of us get the title policy or the title commitment and the closing protection letter from the title agent, and we don't even look at it, right? We just grab it. Maybe some of us may look at the loan number and the mortgagee clause to make sure that that's correct, the borrower name, property address, but we don't really look at the title commitment and see what is actually in there. Is there anything in the body of that commitment that would need to be addressed by the borrower, by the seller, anything that we should be aware of so that we can, get ahead of the game and make sure that we don't have any last minute surprises when we think we're going to be clear to close. And then all of a sudden we find out that there's a tax lien from the IRS that the seller has to pay off for $400,000, and it's a $200,000 sale. That's probably not going to happen, right? So we want to be aware of all of the ins and outs on title insurance. It's just not a box to check off on your list of required items. It is a very important and integral item of the whole loan process that without it, basically, we would not be able to fund these loans. So let's get into it, and let's talk a little bit about title insurance and title.
You gotta share your screen as I get in there.
Oh, okay. I'm sorry. Let me go right into it here.
There you go. All right, I got it.
All right, cool. So let's get right into it, right? So very basic here, right? What is title insurance? Well, we can get into our legal definition there, right? Title insurance being a form of indemnity insurance that protects lenders and home buyers from financial loss sustained from defects in a title to a property. Now, really important to note, lenders will require title insurance, referred to as lenders title insurance, right? Real easy name to remember there, equal to the amount of the loan, right? So that's a required item. Home buyers can also purchase an optional owner's title policy that will protect them for the difference between the purchase price and the loan amount, right? So if it's a $300,000 purchase price, $240,000 loan amount, you got $240,000 in lender's title insurance. And if you get the optional owners, it starts off as $60,000, right? But as the loan balance decreases, right, the amount of coverage from the owner's policy will increase. Basically, it's a supplemental policy. That's why they call it optional, but the lender's one is a requirement. Will not be able to get any of these loans without title insurance. There's a real good reason why. Now, what is the importance? Right, here's where we get into the real good reasons why. Right, what is the importance of title insurance? Right, so the lender's policy ensures, and we got a little redundancy here, but it's got to restate the obvious sometimes. Lender's policy ensures that the lender is covered for the term of the loan for any document issues that may arise that were not noticed during the title review or examination, right? Part of the examination and the review will also include a lien search, right? They'll order a lien search from the city, county, state, whatever is applicable. In, get the payoff, all that kind of stuff that the title companies do, and the cities take a long time to provide. So, in order not to working, another scenario that I had where title insurance saved the borrower. This is one that can happen very easily. Borrower bought the property. It was a property that was in foreclosure. The sale was coming up. It wasn't a cash deal. It was a finance deal. We closed on time before the sale, but it looks like the title company did not send the deed immediately to be recorded. In times when they're very busy, title companies tend, and this is not a good business practice, may group all of their recordings, items to be recorded, and then have the courier go in one shot to the clerk's office and get those items recorded. Well, in this particular case, it was like 5 or 6 days before the foreclosure. We closed, everything got paid, but they didn't file the deed in time, and somebody went and bought it. Apparently, something got messed up. Somebody went and bought the property in foreclosure, and then 2 3 months later, I get a call from my buyer say, "Hey, what happened, Jose? Somebody's showing up here at my door saying that they're the owner of the property." Like what? I said, "Hold on a minute. You have title insurance for that. Let's call the title company and find out what happened. Why could that? Did they delay the payoff? Did they delay the recording of the deed?" They never really told us what happened, but what they did do is they paid the new owner, or the person that thought they were the new owner, they paid them $15,000 to basically have them go away. So right there, title insurance came up and protected the buyer 100%. right? If they maybe would have only bought lender's title policy, I don't know how that would have affected them. If they would have got 100% of their claim paid, or maybe only, what probably would have happened there is that the lender would have got, maybe just opted to, pay off the loan and have the guy keep the property. Who knows? But in this case, there was full coverage, and the title company stepped up, paid $15,000, and took care of the deal. So it's very important that we understand how that works. Another thing that title insurance can cover is incorrectly completed documents. 10 years down the road, they find out that somebody didn't sign, or somebody signed in the wrong spot, and now it's affecting your marketability of your title. Well, the title insurance is going to have to step up and do whatever they need to do to get those documents properly completed. You could have a scenario of a prior mortgage not paid off. That doesn't usually happen so much with like regular mortgages. It may happen with a private mortgage. I had one where it was a private mortgage. They never provided the borrower with a satisfaction of mortgage. And then the original person that held the mortgage died. So I don't know what happened with that one, but they were trying to figure out how they were going to clear that item when they couldn't get a satisfaction of mortgage from the original mortgage holder. And then you have things like unpaid assessments for an association. So you see, I mean, title insurance can be very, very important.
Before you go off this slide, Jose, let's do a bad example. You gave some good examples. But what happens if they don't pay the extra $200, $1,000 for owners, and we get the worst case scenario where there is a prior owner or some sort of ownership where they cannot retain the property? Then what happens?
Yeah, that's penny wise and dollar foolish scenario there, because in that case, all that's gonna happen is the loan will be paid off, and that's it. And the owner
Has no property.
Who thought he was owner has no property, has nothing left.
Has not a dollar. They don't get paid $1 in insurance because they didn't get the insurance for this event, right?
Yep.
So also, let's talk about what happens there. So say that happened the 6 months after they bought it. They didn't pay a lot in, right? The loan gets paid off. But this could happen on month 329 when there's only $20,000 left to pay on the loan. The borrower owns 500, say $1 million. Say it's someone that's paid off for 30 years, in California, where $100,000 house is now $2 million house. Say it's $1 million house. They only owe $20,000, but this issue comes up. Then what happens?
$20,000 will be paid off
to the lender, and that's it. And they lost the property.
You walk away feeling scarred, but again, I say penny wise and dollar foolish.
And again, that policy is only $200 at the start. And if it came in place in that case, where it's over $1 million in claim, that $200 is now $1 million claim. So it's very, as Jose said, penny, what do you call it? Penny-wise, dollar foolish. Yeah.
Foolish, yeah.
And now, especially when it comes towards the end of the loan, where you're on top, right? Where you're now trading places with the lender, where you now have the higher equity to protect that is now unprotected.
Or in a situation where you're giving 20% down, 25% down, 30% down. I mean, that's cold hard cash that you just lost. Poof. And mind you, you mentioned something there. I was about to mention something similar. The owner's title insurance is usually a simultaneously issued policy. So, now there's a promulgated rate for the lender's title policy. The owner's title policy, that's where they can play a little bit with their margins. But you can usually ask for a simultaneous issue cost and see if they'll offer you that cost, which then would make the cost like $250 as opposed to the very high cost that you see. But you do have to check, because that does vary from state to state. right? Each state has its own rate tables for title insurance, where they can't really deviate too much from there. Where they can deviate is on their closing fees, escrow fees, settlement fee, and all these other fees that they hit you with. So how is title insurance purchased? I was just talking about some of that right now. It's purchased through an attorney, which would be attorney's fund, attorney's title insurance fund, something like that, or it would be a title agent. And then there's a number of companies out there, the actual underwriters, right? Like Old Republic, Stewart, uh, Chicago Title, three that come to mind. T-Core Title, and I think there's a few more companies out there. Those are the actual title insurance underwriters. And like I was saying, the rate will be a promulgated rate, and that will vary from state to state. There's some of the states I see out there, like Missouri, for example, and Arizona, that have like hardly no title fees. I mean, like $500-600 for a title policy, and like $600 for a closing fee, and that's it. No heavy duty transfer taxes or recording fees from the state or the county. They obviously want business, so the state has set it up in a certain way to make it more affordable, to spur more real estate activity. I would imagine. So part of the process to purchase the title insurance is the examination of the title. So I alluded to that a little bit. You'll have an actual title examination that's completed. If it's an attorney purchase, if you're purchasing from the attorney, that actual attorney will do the title examination. If you're purchasing it from an agent who uses a title insurance underwriter, then the underwriter will actually provide the examination, right? Which is where they'll look at the abstracts and all the other areas where they could find information on the title. The agent will also order a lien search to see what comes up, and then they'll do the other searches, like I mentioned, the code violation searches and the other notice of violation searches, and see what may be pending that may turn into a lien. They look at the utilities, like water. Water is a lienable item. Electricity is not, but water is. So they'll look at those kind of things and see what there is, and then provide you a whole report. And those usually are items that have to be paid by the seller at closing. The title examination is also going to look for defects in the property's chain of title, and then the title commitment will be issued. Now, this is the part that I was getting at, that we got to be aware of what the title commitment really is providing. What is it? What is it explaining to us? It's not just, like I said, a box for you to check. Okay, got my title commitment. Okay, got my closing protection letter. Next, because you don't want to be surprised a week before you close when they'll tell you, oh, but didn't you see on the title commitment that it said, I needed blah 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 blah. A good title company may be proactive and tell you certain glaring items, but you know what? They're super busy, and if they are super busy, they may not. They may expect you to actually read the document that they're sending you, instead of they're having to spoon feed you. So it's good that Schedule A is mainly like the cover page, right? That's the page that says the loan amount, purchase price, who's the seller, who's the borrower, who's the insured. That's going to be Schedule A. Schedule B1 is going to show you what are the requirements that must be met in order to issue the title policy, because it is an insurance policy. So after they review it, they get the examination. There's going to be certain issues like pay off of the current mortgage on the property, or the current loan on the property that was taken out in December 12th of 2008. Whatever. They're going to list certain things they may tell you that the taxes were already paid, or they may tell you that the taxes aren't paid yet. Different things like that are what are going to appear on the schedule B1. So that's why it's really important for you to read that and note, if it says that seller has a $220,000 tax lien, make sure that the seller's agent is aware of that. So the seller's not caught off guard and all of a sudden blows your deal because you go to close and they're like, oh, no way. I can't come with $150,000 to closing. I didn't realize this was going to have to be paid at closing. So, don't get caught off guard. And then Schedule B2 is the exceptions, which are items that the title company will not cover. And I look at easements there, and I recall loans that I just closed that had some title issues that threw us a curveball having to do with easements and with covenants, because it was 5 properties being purchased from the developer. That was like the developer had developed it in a certain way with certain covenants, and then tucked away in there deep in the Schedule B2, they were talking about covenants and easements and different documents that had to be provided to them in order to clear that exception. And that delayed our deal by like 3 weeks, almost a month, to be able to close, and almost blew the deal. So, something like that you may slip right by it, but believe me, the underwriters will not. And then you got other basic stuff like mineral rights, water rights. Here's an interesting one: tax assessments on new construction, because the new construction has usually a low tax amount. It could be 500, 800, whatever was the value of the land. And then next year you're going to have a higher amount. Well, they're not going to be responsible for the fact that they only collected for $800 now, and next year you may actually be responsible for 8,000. That's just the way it is when you purchase new construction. Things to be aware of. So, title vesting. Now, this is something that I think is very important to note in general when you're setting up your loan, because a lot of times people click whatever and they don't really know why they're clicking. Obviously, the sole ownership one, that's an easy one, right? Because that's just a person who's holding title by themselves. But where it becomes a little trickier is when you have multiple people on title, if they're married, if they're not married, if they're a group of investors, right? So, if they're married, you're looking at tenants by the entireties is a really good one, because what this does, this allows it allows for asset protection, because the property is not divisible by creditors to satisfy the obligation of only one debtor's spouse. Really important when you're looking at certain things, like when they're putting liens on credit, due to credit cards and stuff like that on an individual. Tenants by the entireties becomes a pretty important consideration at that time. Joint tenancy or joint tenants with right of survivorship is another really good one, also for married couples or for a couple in general that wants to keep the ownership of the property amongst themselves, right? So let's say a husband and wife own a property together as joint tenants with right of survivorship. The husband or the wife passes, the deceased spouse's percentage of ownership goes to the surviving spouse, right? There is no having to worry about probate or anything like that. It goes directly to the surviving spouse. So that's a really good one for that. And then tenancy in common is a really good one, for investors, right? When you have multiple people owning a property, where they're divvying up the property in whatever percentages that they want, 20, 20, 20, 20, 20, or whatever it may be, right? But here's where it varies from joint tenants with right of survivorship, is that in tenancy in common, when you die, your interest, your property interest, in other words, what the percentage of your ownership in the property, uh, goes to your estate, right? And then to whoever are your heirs. Maybe you have a will that you wrote, so it goes to your estate and gets distributed according to your will, or it gets distributed by probate court. So you really want to have a will, or you really want to have something else in place. Um, and I guess one thing that is not common, but I didn't mention here, would be a life estate, right? Your parents are getting on in age. You probably will want to do a life estate deed, which is a deed that has the owners on there, but also names a remainder man, which is the person who becomes the owner once the current owners die. So current owners die, it passes on to the remainder man without having, or man, remainder people. I don't know how they put it in the document, without having to go through probate or anything else. It's like an automatic. I guess you got to have the death certificate, probably, to show. But that's basically it. So life estate. But a life estate isn't really one that you would do vesting at title, though.
Does a remainder man have interest in title and can be the borrower on a loan?
That's a good question. I guess you'd have to. I was wondering myself that on one that
the way you just explained it made it sound like they can be a borrower.
Well, they're the ones that will be the owners once the current owners die. So I don't know. I think it would probably be the current holders of the life estate have the right to do whatever they want with the property while they're alive, and then when they pass, their interest goes 100% to the remainder man. I don't think they can do anything until while the current owner is alive.
So they have some sort of equitable title, but not actual. Not actual full interest. Gotcha.
Correct. And also, the current life estate holder can sell the property and everything while they're still the owner. Just the fact that you have a life estate doesn't mean you're not the owner. You just it would be more of estate planning, type of maneuver.
Yeah.
So
we should have introduced why you know all this. Jose used to own a title company with his wife, so Jose is the resident title expert. If our team has any questions,
the wife had the title. She was good. Now, I put seasoning there, right? Because I want everybody to know what I'm talking about, right? But this is not seasoning that you're actually going to sprinkle on your title. It's not seasoning that you're going to sprinkle on your paperwork. But, you definitely, MLOs, need to be aware, though. And we talk about this in our trainings all the time, seasoning on title. What do we mean by seasoning on title? Is just the ownership, right? The ownership, and and how long they've owned it. Really, is when they talk about seasoning on title, how long someone has been on title. And then you also want to look at the chain of title, right? Because that is going to affect, seasoning on title will affect your loan on a purchase as well as a refi. People say, why a purchase? How can it affect you on a purchase, right? Well, I'm going to tell you real easy. We do a lot of non-QM, right? Probably 70-80% of our business could be non-QM. And on a non-QM loan, there's all of the investors are going to have some sort of worry about a flip. If the buyer is purchasing a flipped property, then you have to look at the guidelines for the investor where you're going to be submitting that loan to see what their guidelines are. Some will say 3 months, some will say 6 months. That they would require you. Some will be as lenient, and some will say 12 months. Some will be as lenient as saying, "Oh, you got to provide a second appraisal," right? And some will say, "No, I'm sorry, we're not going to be able to give you the current market value. We're only going to be able to give you the sellers, the current sellers, what they paid for their purchase price plus whatever improvements they've done to the property." That could really kill your deal, right? If you're looking at a property appraised for 350, the person did a good flip, right? Got it for 150, put in 75, now it's worth 350. But at certain outlets out there, you'd be getting 225 as an appraised value and not 350, which could be the market value, but just due to the guidelines on how they're treating seasoning for the purchase, it could blow your deal. And that's on non-QM. FHA, I think it's 91 days. So if it's an FHA flip, the borrower slash buyer cannot enter into a contract to purchase that property until the 91st day after the current seller took title. So you see now seasoning on title on an FHA loan really important. And if you don't have, I mean, first it's just 91 days just to get on title. I mean, just to get into a contract, you got to wait. The contract date cannot be before that day. And then on top of that, there are certain additional hoops of fire that you're going to have to jump through depending on the amount of value appreciation. They may require a second appraisal. I can't remember what the threshold is for that right now, but depending on the threshold, if you're above and beyond a certain amount of appreciation, they're going to require a second appraisal. And that's FHA. Conventional doesn't have any title seasoning issues like that for purchases. Now, on a refinance, on a cash out refinance, or even on a rate and term refinance, you got to look at the guidelines because some of the outlets on rate and term refinance have a seasoning requirement as well as on a cash out. But most of them have the seasoning issues on cash out refis, where they're going to limit you as to when they're going to allow you to use the appraised value versus the purchase price plus closing costs, or versus the purchase price plus renovations and repairs that may have been done to the property. Now, at the mortgage calculator, we have a lot of options, a lot of workarounds for this. We have options with zero seasoning. This will be for a purchase or for a refi. But in this case, I'm talking about refi. If you were on title yesterday, you can do a cash out refi today without and be able to use the appraised value. We have options at 6 months, and then like everybody else, options at 12 months for our non-QM cash outs. But obviously the best ones, the ones we love, are those zero seasoning options. And on a conventional loan, there are seasoning issues on cash outs also. Cash out refi, to be able to do it at all, have to be 6 months on title, and to be able to use the market value instead of the purchase price plus renovations, you have to be 12 months on title. Now, I don't want to confuse
let me throw
anyone with a delayed financing.
Oh, that's what I was just gonna say.
Yeah, I knew it.
Well, first thing, cash out determination of value is what you look up in the guidelines, guys. You're not going to search for seasoning. It's probably going to come up with no hits, right? Cash out determination of value is going to tell you title seasoning. So it's a little bit misleading. It's not going to have a chapter called title seasoning. It's going to have a chapter called cash out determination of value. And then, yes, the delayed financing is the only workaround to these rules. So I don't know if you probably need a whole slide for that. But
Yeah. I mean, the delayed financing is the borrower that purchases the property without any financing against the property. It doesn't mean it has to be a cash sale. It could be a cash sale. They got to prove that the cash came from their account. So you have to show like debits from their accounts and that they were the owner of that account, whether it be an LLC, corporation, personal, whatever, right? But they could have bought it with a HELOC that they have encumbering a separate property. That would still be considered a cash sale because you're not encumbering the subject property with a loan. And so you do your then when what they call it delayed financing, because then within the first 6 months you can do a refinance of the property without being hit with the cash out limitations. But they will put a limit on the amount that of the loan, though. Usually, the amount of the loan is going to be, I believe, equal. The amount of the loan cannot be greater than, I believe, what you paid for the property plus the improvements. I believe that's how it reads out. But
and it still goes by purchase LTV instead of refi LTV. So sometimes you can get closer.
But they will let you go use the the current market appraised value. That's the big benefit of the delayed financing, especially if you haven't done any renovations or anything like that. Will be that you could have a nice low LTV, right? You could have a nice low LTV and then have no mortgage insurance if it's agency, or have a nice low rate and fees if it's a non-QM loan.
Hey, Jose, real quick while you were on that slide. So you're telling me basically I'm not doing any crazy flips. I'm not doing any fix and flips and stuff. I'm just buying a property, right? But we still need to worry about if the person we bought it from was doing a flip and stuff. That's what we're saying here.
Yes, sir.
I still need to be careful as the loan officer, especially looking at these deals, understanding that, it doesn't matter if we're doing a fix and flip. This can affect us if the person who we're buying it from hasn't been on title long enough.
Correct, man. That is a really tricky situation too, right? Because that one can bite you, where, real easily. And especially if you don't read the title commitment. Let's say you didn't do your due diligence, because something we should always do as an MLO is we should do some due diligence on the subject property. Obviously, if it's a cash out refi, but in the less obvious one that we're talking about right now, which is a purchase, right? You should do your due diligence and see what you're dealing with, right? First of all, you're going to look at, property address. You're going to look at zoning. Is the property zoned for what it is? Does it look like in the public records like what the borrower is telling you that they're buying? They're telling you they're buying a 2 or 3 unit property. Public record has it as a single family, 3-bedroom, 2-bath. What are they actually buying, right? But then where you're going to see how long the seller has owned it. When did they take title to the property? How much did they pay for it? Different things like that could be some red flags. But assuming you didn't do your due diligence there, that is why it's so important to look at the title commitment, because on the title commitment, and I think it's on Schedule A, where it mentions the day that the current owners took title to the property. And that'll let you know if they took title 2 months ago, 3 months ago, or something like that, you're going to have a problem. You better make sure that your guidelines allow for that, or else you're going to have to do some restructuring of your loan. So real easy to get caught by that one. So like what we were just touching base on there right now, MLO best practices, right? Identify and address issues up front, right? Do your due diligence up front on that property. Read the title commitment. Don't get caught off guard thinking you're going to close, and then all of a sudden you get thrown a curveball. You got to communicate and collaborate with the title professionals. Reach out to them once you do get that title commitment. Reach out to them with any questions or concerns, or, you're not a title attorney, so just reach out to them and say, hey, is there anything in this title commitment that I should be aware of that needs to be addressed that's going to affect my closing. If they didn't tell you before, they'll be sure to tell you then, so that you can then reach out to everybody in the transaction, whether you're representing the seller or the buyer, to handle that. And I already mentioned there, read the title commitment once received for issues. And very important, educate your borrowers about the importance of title commitment. With all the pointers that we've covered in this presentation here, it is a nice overview of what it's about, so that if your borrower, like I had one the other day, she was putting 25% down on an $800,000 purchase. Owner's title was like $600 or $700, and she was questioning, should she didn't think she needed it, she didn't think she wanted it. So I replied to her, copying the title agent. I think you should reach out to the title agent, because owner's title does cover you, especially if you're giving 25% down. It is going to cover you for some important items there. So, please reach out to the title agent for additional clarification. And I think the title agent reached out to her once she was copied in my email, and within a couple hours, she's like, "No, Jose, forget it. Keep it on there. I'm gonna keep the coverage." Because again, it's $600-700, but as Nick and I were talking about a few minutes ago, you could see how important it could be down the road, if anything should happen. So again, a lot of this is just dotting your I's, crossing your T's, being proactive as an MLO, to ensure that you don't get caught off guard, that your seller or your borrower don't get caught off guard, which will result in a nice, easy closing, and hopefully will result in future business referrals for you.
All right. I don't see any actual questions. The one question I see is, why did Claudia leave the title business?
The recession of 2008, the crash, the title underwriter that we had at the time, Stewart Title, basically canceled everybody. They didn't want to. They only wanted to keep title attorneys, so they just canceled every title agent that was out there, and we were one of them. And by the time that business picked up, the wife didn't want to be a title agent anymore. So what could we do? Now she's a realtor.
Yeah. All right. So remember, we do this Tuesdays and Wednesdays. So tomorrow we'll be right back here, 7 p.m. Eastern, with a different topic. I forget what the topic is tomorrow, but we'll have a different topic here tomorrow. Make sure, as Jose said, dot your I's, cross your T's, and make sure that you are aware of the title issues here. So thank you, everybody, for tuning in. We will see you tomorrow, 7 p.m. Eastern time, like we do every Tuesday and Wednesday for the Loan Officer Training Series. Appreciate you tuning in. Thank you, Nick. Thank you, Jose. That was a great presentation. And we'll see you all tomorrow, 7 p.m. Eastern. Take care, everyone.
Thank you, everybody.
Thanks, everybody.